Well, I'm feeling kind of like shall not be infringed, because this is a video response to Urban Combat Survivor. What's up, fellas and lady? Oh, so we got the Fed is going to pump $600 billion into the economy. Now, what they're going to be doing is they are looking at the target range for the federal funds rate to stay within 0 to 0.25%. I'll explain that shit as best I can. That's in the second paragraph down there. There's a link to this site. This is actually the Federal Reserve's website here that we're looking at. The top paragraph, if you want to pause it or whatever you want to do, you can go ahead and read it on here, but I'll have a link to it. What ends up happening, these cats have their little meeting, and what they intend to do is go into the open market and purchase some of these longer term treasuries. Now they're not going to be printing money out of nothing. They do print the money. They get the money from the treasury, but they take the money from the treasury and they use those dollars to buy back grandma's treasury bills. So it's not like they're just, well, we're just going to take this big old box of money and just throw it out onto the floor and whoever picks it up is going to be able to buy shit with it. It's not like that. Further, the treasuries that we're talking about are one of the contributing factors of the national debt. So what you're going to see is going to be a $600 billion decrease of national debt for a short time. I know it's a bit confusing, and we'll get into it next week if there's enough interest on this, which I'm sure there will be. And there's naturally, I know of a couple people directly who know more about this banking shit than I do. I have just a basic, moderate understanding of banking and investment, but I do have some. So what'll end up happening, there's going to be some more dollars into circulation, and what the rest of the article says is it's in the hopes of getting some more money out there to promote jobs and ease the ability of banks to finance and loan. Now I work, believe it or not, one of my jobs is, believe it or not, associated with a financial institution, working with a financial institution. And here probably, I want to say it was 12 months ago, you could not get a loan if your credit score was anything below like 720. It was very, very high. And recent actions taken by these people have brought it down to a more reasonable level to where a person can still get a loan, making the economy become stimulated and stuff will get to circulate again. Now, hopefully, they'll address this issue of the Federal Deposit Insurance Commission, because what we can't have, in my opinion, is a financial institution that takes great risk and blows all their money on poor investment have the exact same protection at the exact same rate that a more stable financial institution that loans out responsibly has. But we'll get into this if you guys are interested in it, and that's what I got for today on this. Thanks a bunch for your time. We'll be seeing you later.